Thank you very much, Don. It's great to be here. Oh my God, I don't even like to look at myself in the mirror, let alone something like that. Whenever I come to this conference, I remember 1986, I guess, when 30 or 40, we didn't know what we were called then, got together in a convent in Massachusetts and to talk about whether there was a movement bubbling up and whether we knew what we were doing. And we slept on beds that I'm sure had spikes in them. You know, they were sort of hard. But it's amazing to see what all of you have created. And so we're here today to maybe move the agenda a little bit. Our idea for this panel is that each of my very capable colleagues here is going to, I'll introduce in a second, is going to lay out a provocation. Their job is to put out a provocative idea, not to make a presentation, but do the provocative idea. And then we'll go through their provocative ideas. I will, as the moderator, ask a few questions about the ideas, and then we'll turn it over to you to engage in a conversation about their provocative ideas or other potential innovations. I want to especially thank Bill Bynum, who filled in for Cyrus from the Treasury Department. We actually wanted to give Bill the job of running the Treasury Department since the government was shut down, but and restructure it all, but apparently that was not in the open offer. So I don't think anyone here needs an introduction, but I'll just go to my left. Kathy Dolan, the very capable Chief Operating Officer of OFN, who has a long career in banking before that. Apparently we used to argue about credit issues, you reminded me, but it was all in good fun. Randy Rice from Trillium Asset Management, who's going to come here with, and also on the board of an emerging CDFI, right? A startup CDFI. And then one of the real longtime stars, sporting a beard now, Bill Bynum, from Hope Credit Union, with all of the tremendous work that Bill has done and accomplished in the Mississippi Delta down into New Orleans. Did I say that correctly, New Orleans?
Close enough. That's
Getting close.
New Orleans.
New Orleans, yeah. Yeah. It's my Philadelphia twang doesn't quite do it, yeah. So we'll begin with Bill, and then we'll go to Randy, and then we'll go to Kathy. Each person will speak for 5 minutes, 7 minutes, whatever, or less, whatever they choose to do, and then we'll ask questions and we'll bring it up. So Bill, provocative.
I have a problem being provocative, so bear with me. And no, I'm really glad to be here. And I have to comment, this is not the National Association of Community Development Loan Funds. I mean, this is a very different and really exciting room that we have here today. This industry has come a long way, and Jeremy, you've been one of the leaders, so thanks for all you've done over the years. And I'm not Cyrus. I don't think you would wish upon your friends to run the Treasury Department. It might be interesting for a day or two, but I'm glad I have my job. Let me start by saying I like bankers. Some of my best friends are bankers. I've done a lot of business with bankers over the years, and I still do. There's a friend who's a banker happened to say last night, bankers are not the evil squids they are sometimes depicted to be. And I think we all know this to be true, but we also know that as a rule, banks don't adequately meet the needs of low-income, Black, Hispanic people in the communities where they live. And there are many reasons this is the case. I won't get into those at this point, but no reason would exonerate banks from the responsibility to the places that to serve people in the places that fuel their profits. And profits have been quite strong recently, 141 billion, I think last year, highest since 2006. A fact supported to a significant degree by public investments in a largely self-induced financial crisis. So, however, despite these profits, the numbers of unbanked and underbanked people have risen dramatically since the recession as banks have closed branches in record numbers. Bloomberg reports that 93% of the 1,800 branches that have been closed since the recession have been in low-income areas. In my home state of Mississippi, 64% of black residents are either unbanked or underbanked. 64% of black residents don't have an account or rely on predatory lenders. And so clearly traditional banking is not working for these people in the places that we're talking about, many of us serve. And I'm not suggesting for a minute the banks don't care, they do. And most would like to do more, but the existing structure doesn't allow them to do what we do as CDFIs. Y'all are quite subdued. I think when the deputy mayor said that CDFIs were at the core of the solutions, y'all should have stood up, we should have stood up and given them a standing ovation, because that's significant when the deputy mayor, head of economic development, and a city as significant as Philadelphia acknowledges the important role that we play, particularly in this day and time. That's significant. That's not where we were years ago, but it also makes an important statement. So banks care, they want to do more, but the existing structure doesn't allow them to do what we do. Neither do their shareholders, nor do their regulators. And at the end of the day, they're not going to make a loan to Bobo or to many of my or your customers. So what do? I'm so glad to see many banks here as sponsors and participating in the OFN conference. I think it affirms the fact that they recognize that the work that we do is a logical, we as CDFIs are logical partners if we're going to address the capital gaps that plague underserved people and places. And so since we're all here, why don't we get serious and stop working around the edges? I propose that we work together to have Congress modify the definition of CRA assessment areas. And while we're at it, let's require all banks invest a percentage of their profits in a non-government managed CDFI fund. Not to dismiss the CDFI fund, but I think OFN, AEO, Co-op Bank, lists intermediaries who are in the weeds and understand how CDFIs work and aren't subject to the bureaucracy that the fund is, or could do a significant job, a significantly impressive job. I don't know if that's a little provocative, but as I stated, I think CDFIs are the logical response to increase services in underbanked communities. However, structuring this capital in order to respond to those needs is very difficult, particularly for CDFIs in rural and minor urban markets. This is aggravated by the absence of mega banks, large foundations, corporate philanthropy, and decimated state budgets. In the Mid-South, in Mississippi, Arkansas, Louisiana, and Tennessee, where I work, you just don't see that kind of resources. And bank CRA assessment areas leave a big donut hole in our region and in many of the regions that we serve. Banks are a major and important source of CDFI funding. However, CDFI funding are driven by CRA considerations that are antiquated. It used to be deposit driven. Well, banks get deposits, they get revenue from places beyond where they have a branch. They get revenue-derived profits from credit cards, investment services, mortgage purchases, you name it. They're getting revenue from billions of dollars from Mississippi, but they don't have a CRA obligation in my state. So I think we need to move CRA out of the past and into where currently the current realities. The bottom line is that banking and finance has evolved, but regulations originally designed to address disparities such as redlining haven't evolved as the banking system has evolved. And if CDFIs are going to stand in the gap and address the historic disparities and the current disparities, then we need CRA that's going to do what it was designed to do in the first place. If there was ever a time to position CDFIs as a cornerstone in this nation's financing system at the forefront, not as an afterthought, then that time is now. Let's get serious and do it.
Thank you. So before we move on to Randy, the provocation is to create a post-depository CRA that would upstream capital into a national CDFI fund not run by the government, but in some way that we would have to play out. Is that
to a national fund or several funds, intermediaries that disperse the funds. That's right.
Great. Thank you so much.
Thank you.
Randy?
Sure. So I'm here representing mission-aligned investors. Trillium Asset Management has been doing CDFI investing, CDFI-like investing for 30 years. In my career, I've invested $125 million in CDFI-like investments. For perspective, The New York Stock Exchange is expected to invest $153 billion today. So there's a real gap there. So I want to. My whole goal is to help my clients invest in your CDFIs, and one of the things that is still missing from the CDFI industry is standardized standardized data, financial, and impact that is instantly available to our investors. The CARS rating program, which I'm on the board of, has certainly moved the industry forward on that. It's not the answer to everything. The new data platform is certainly going to be interesting, and it's going to help. But the real roadblock right now for mission-aligned investors to invest in your CDFIs is the custody of your promissory notes. Let me, a little example. So if my client invests $100,000 in Boston Community Capital, which we certainly have done. We say that investment is worth $100,000. Our clients certainly have given us permission to say it's worth $100,000. Boston Community Capital certainly says it's $100,000. But in the current state, the way policies currently are, these investments are non-SEC registered and Securities and Exchange Commissioned, and custodians, that is brokerage houses, don't have an incentive to hold your notes, to report to our clients and to us the value of those notes. And without that valuation, the SEC, it raises a flag for the SEC, because we're billing our clients on, in this case, $100,000 worth of investments that has no value. And of course, we all know it has value. In the $125 million that in the last 15 years our firm has invested, we have only lost $350,000. Now, I'll put that against anyone's record. But without a third-party valuation, without policies that allow for easy third-party valuations, without partners in these brokerage houses saying that these investments are investments. They are not philanthropy, they are investments, they have value, they return an interest, we're not going to get to the next step of a flow of capital from mission-aligned investors. Post-Madoff, it took us years to work with the brokerage houses we were. Post-Madoff, our brokerage houses instantly dropped all of our CDFI investments, all of them, because they said as unregistered investments, they're just like hedge funds. Now, there's nothing more different than a hedge fund than a CDFI investment, but because they were both unregistered investments, they were thrown off the platform. And it's taken us years. And in fact, just last week, I was able to share with Northern California Community Loan Fund, our investment, the folks we worked with finally understood that their investment was an investment. But we need much larger policies. We need an SEC that recognizes that these investments are investments and they have value. And certainly we need our friends and allies in the banking industry to realize the same thing.
Thank you very much, Randy. So your provocation is that there's some moment of intermediation that isn't here yet.
That's right.
And it is related to the custodial function.
Right.
And yet to create that custodial function, we'll come back and with questions. There are lots of things that have to happen. You can't just hang your hat out and say, yep, custodial function, I'm here. there are all kinds of recognitions and all kinds of transparencies and all kinds of sort of social assumptions that have to be at work and economic assumptions. But we'll come back. But also, as with Bill, I think a terrific provocation. So Kathy, provocation number 3, take it away.
For those of you who know me and have known how much time I've spent on the CDFI bond guarantee program and how much time OFN and how much effort OFN has extended to making that as successful as possible, I can't tell you how happy I am for one brief moment not to be talking about the CDFI bond guarantee program. There's plenty more time to talk about that, but for the moment, I'm going to talk about something else.
So this isn't Bond and Beyond, this is just Beyond.
This is just Beyond.
Gotcha.
So I've been working on raising capital for community development and community development finance for a really long time, both as a banker and at OFN. And I've concluded that truly there are no real new ideas, at least no new big ideas. But there are old ideas or current ideas whose either time has come because the environment is different, or for which maybe if we tweak or modify a few elements of these ideas, they could actually work for the CDFI world and community development finance in general. And one of those ideas that I want to talk about today is the concept that CDFIs stop being true financial intermediaries and be a Trillium asset manager. Our expertise is not necessarily in raising capital. Our expertise and our value add and our differentiating factor is in knowing the local markets, being able to identify the right kinds of financial solutions for the problems that ail our communities, and originating, servicing, managing, getting repaid. Leave the capital raising to somebody else. Become asset managers. The main reason for that is because we'll never get there as true financial intermediaries, as principals for investing. And the reason is because our balance sheets are constrained. We can't raise net assets fast enough to grow at the rates in which we need to grow to be the solution providers that we all aspire to be. We are profit making, but we are not profit maximizing. And as a result, we can't raise equity capital the way the for-profit world does. We march to a slightly different drummer, but as long as we march to that profit making, not profit maximizing, we can't raise capital fast enough to be principals, where we invest for our own accounts, we borrow money, and we on-lend. We can do it incrementally, but we can't do it fast enough. So why not eschew the whole role of being true financial intermediaries and simply invest on behalf of other investors? And why does this make sense other than from the very practical point I made about the growth constraint? It's because I think more and more the new capital providers, they don't want to invest in intermediaries, right? They want to see, they not only want to see the impact their capital makes, they want to actually be involved in choosing what impact they want to have. So be it the high net worth family offices, the class of new socially motivated investments, or crowdfunding, right? Crowdfunding is not crowd investing, but people want to go online and pick the transactions or the initiatives or the businesses that they want to fund. They don't want to invest in ABC CDFI, who then figures out which businesses to finance or which projects in a low-income community to finance. Most investors want to actually be on the streets and seeing the impact of their capital. So why don't we let them do it? And we as CDFIs can become the asset managers for the opportunity finance asset class. Just as there are, PIMCO is known for being an asset manager in the fixed income, or for a high growth asset manager who runs mutual funds or pensions funds that want to invest in high growth equity. CDFIs can become the asset managers for the opportunity finance asset class. And we can focus on where we add value and where our expertise relies, which is not necessarily on the capital raising side, but on the origination and stewardship of the investments we make in our capital. Now, for that to happen, because this isn't a new idea, right? For that to happen, there are a lot of regulatory changes that have to be made. There are some technology changes that have to be made. And there is a little bit of light at the end of the tunnel. Some of you may be familiar with a recent Jobs Act, which is trying to make raising equity online easier, raising investment capital online more easily. The SEC registration process has been loosened to allow investors to invest more directly into whatever they're interested in without having to go through a bureaucratic registration process. I think that holds promise for our industry. I think a little bit of what Randy is talking about from a custodial standpoint, that if we can create some regulations, regulatory environment and a legal environment that allows investments to flow to profit making but not profit maximizing, to impact-oriented investing as opposed to highest return, then I think we can create an environment that would allow CDFIs to be asset managers as opposed to true financial intermediaries. And the last thing I want to say, because it underlines all the conversations we're having, is you got to start this conversation with the premise that we are trying to align capital with justice, not the other way around. Many of these conversations always start with what's the current system call for, and how do we change what the community development finance industry is doing to fit the current requirements. And we want to turn that situation around. We want to turn that question around. How do we actually change the current system, capital, to meet justice?
Thank you, Kathy, very much. It's another terrific provocation. We've had three great ones. Now, what I'd like to do is to go back down the line, go from Bill to Randy and Kathy, and ask them a question about what they just said, probe it a little bit, and then I'll ask a general question, as I noted, and then we'll begin the broader conversation. So, Bill, when I was listening to you, it struck me this wouldn't be so popular in some places, and that this would be viewed by some as a kind of a redistributive attack on profit making, right? And the notion, and then secondly, and I think you said this, is look, the notion of CRA was rooted in an analysis that said it goes back to the 70s. It was part of the fair housing legislation. You guys are taking in deposits here, but you're not making the loans over there. It was a kind of a broken sense of reciprocity or quid pro quo. That was really the notion of fairness that was there. Sure. You're suggesting that, I think, that there's a case to be made in a non-deposit, given mortgage banking, given all the things that go on, that there's a kind of a non-depository case to be made. So I guess one question I have for you is, if I'm understanding it the right way, is do we have a research task in front of us? Do we have an empirical case-making task in front of us, or has that already been done in some way? And should we, if we want to build this idea, should we as an industry, is that one of the big, as an idea, is that something we have to take on? So that would be part number one. And then to even push the provocation a little further, and I'm sure this isn't, these are not things that will happen tomorrow. Many of these institutions are global institutions. And so is there even a global case to be made eventually? So let me just sort of ask those questions.
No, thanks, Jeremy. And I think I'm glad that you sit as the chair of the Philadelphia Fed. So you can help you can help make the case. But I think as far as the issue regarding redistribution, you know, I don't want to be callous, but so what? I think the absence, the absence of regulation enforcement at CRA level has meant a redistribution of profits upwards towards shareholders at the expense of the communities that we've talked about, the communities that we're all trying to serve. So I think when CRA, CDFIs in themselves, we redistribute profits. So I think that's something we probably need to recognize, acknowledge, and own. So I think as far as the research task, we all know anecdotally that the demand is there, but I think documenting that demand clearly so that we can make the case more strongly is important. So what is the viable demand for CDFIs to deploy capital? After the 2008 election, we sat down with the transition committee and talked about positioning the CDFI industry as a cornerstone of the financial system, not something on a periphery. And while there has been increased investment under this administration, more than there's ever been, we know that the CDFI fund, the new market tax credit, all the programs that have been put in place are dramatically oversubscribed. They're underfunded. So the demand, we know the demand is there, but I think documenting that demand is important. I think when we were making the case for investment of TARP funds in CDFIs, we talked about the need for, there was $3 billion in demand that CDFIs could meet, given the pulling back of banks from lending in many communities. That was something we pulled together from some OFN data, some other sources of data, but I think documenting that is important, and we can say this is the viable demand. We clearly know the performance of CDFIs. We can make that case, but I think that's the primary research task, is documenting the demand.
So let me just push it a little further, and since we've got some Fed people here in the audience, I'll give them a hard time about it some other time. But in the 1970s, the case was there was a process of extraction without a complementary process of investment.
That's right.
I think your case that you're making now is that that's happening, but in a different way. And so that the circuit is broken, or the circuit isn't complementary enough, or the circuit isn't reciprocal enough. Not that the demand isn't there. And so I would think that the case that has to be made, I sort of intuitively believe that, but I think that's the question. How do you do that? And now, one of the interesting things about the Fed right now is that since the recession, the Fed has a bigger role, including a bigger data role, over non-bank financial institutions, particularly those that are viewed as potentially having could cause systemic risk. Did I say that appropriately, Melissa? And so that means that I think the data is there to try to understand those circuits better than we ever have before. So does that make sense, Bill?
It does, and I think another research element is looking at where banks derive their profits.
Right.
Clearly, branch banking is important, but it is not the accurate way to define CRA assessment areas. As I said, we don't have significant presence of Chase, Wells, B of A, the major banks, mega banks in Mississippi, but there's certainly revenue, profits being derived from the people in those places without the reciprocity of CRA investments. And so I think redrawing the box, acknowledging where banks really get their profits from is something we need to ground in good data
Great.
as well.
Thank you, Bill.
Jimmy, can I actually add
Sure,
something to
please.
that? I think you take it to its logical next step, which is it's not just about banks anymore.
No.
You know,
That's right.
when was the last time the banks were the primary element or primary actor in the global capital market?
Yeah.
They're an important actor, but they're not the only ones. And so I think you have to take the concept and broaden it across all financial services and have that same similar affirmative obligation to give back.
I think in general we would agree, I think most people in this room would agree that CRA was constructed with a very different financial architecture in mind.
Yeah.
And it has significant limitations for this architecture. So a major provocation is to build the case for a really different kind of architecture, is what I think you're saying. And I think
Exactly.
it sounds right. Randy, I loved hearing your perspective on the role of a custodial agent here. I'm hoping you can talk a little bit about what the obstacles are in front of us. I mean, it just, again, this isn't my area, but intuitively would strike me that if everyone was rated by a system that everyone, agreed to, there's a, if you think about Moody's and Fitch, there's a sort of a social agreement, whether that's right or not. There is a social agreement, actually once was a legislative agreement, going back to the 1930s, about that will recognize those ratings. Do we need that? Is there some other form of market legitimacy that is needed? How would it happen in your mind to do this? How would we get there?
Sure. Well, so I'm also on the board of a small CDFI capital good fund based out of Rhode Island. First real active CDFI in Rhode Island. I'm very proud to be part of that. In the capital good fund, since I've joined, the whole goal, or my goal, is to have this tiny CDFI grow, standardize, and use the best tools available. So from the second I got on the board, it was very clear that my goal is to get the CDFI cars rated, because that's a marker. It's becoming a litmus test. Either you are or you're not, and if you're not, why not? and I don't want my CDFI to be in the if not, why not? Standardized financial data is certainly important, but when we talk about mission-aligned investors, we're not dealing with folks that are looking for market rate, which is code for all we care about is money. That's what market rate is. All we care about is money. Our clients and the sustainable and responsible investment industry is also looking for positive social return. We want to know that our investments have impact. And of course, the holy grail for sustainable and responsible investors and the CDFI industry that we're just beginning to understand is how do you measure impact along with your finances. And so while there certainly needs to be standardization across the industry on how notes and offering memorandums and prospectuses are created, and how interest is paid, and whether it's paid on quarterly, semi-annually, whether it's on 365 days a year, those kind of things are pretty simple as compared to remaking CRA, and would certainly help move the industry toward being able to access much more capital from mission-aligned investors. Obviously, I think that CARS is very important. As important is standardized financial data that is current, and so we're looking for that. A year-old audit. If you live through 2008, 2009, a year-old audit, that doesn't do you much good, right? And so, making sure that CDFIs are making that information available in a standardized way so that investors can look at the information in a standardized way, that we can compare ourselves to ourselves, that we can compare ourselves year over year, is going to be very important if we're going to come to scale.
So you're saying the major barrier to entry is standardization and transparency?
Certainly,
Okay.
standardized transparency and updated data, current data, is a barrier.
So the conundrum of CDFIs has always been, in my mind, that I want the rewards of standardization, and I want to be able to function in as a boutique manner as I'd like to be able to function,
Sure.
to be able to reach that market. And that's actually a reasonable tension, right? That's
Absolutely.
the creative tension of the industry. I don't mean that one side or the other. We're sort of looking for both, right?
Right.
And we want to be profitable without being profit-making, but we would like to have the kind of capital call ability that a profit-maximizing organization has. That's the other sort of tension, the other way of saying it, or as we used to joke years ago, we want to be able to take equity positions with debt returns, right?
Right. And debt risk. Right.
And debt risk,
Yeah.
right? And so this idea of a custodial function, being able to do that,
Yeah.
and being able to manage its way through SEC, how does it, is your suggestion only for, and I don't mean this only in a dismissive way in any way, is that only about socially responsible investors because you think that market is robust enough and let's just solve it there? Or are you looking towards something that is larger and broader and something that you could sell paper to that somebody might buy from a Vanguard or, a Fidelity? How do you look at it?
Sure. One of the goals of the CDFI bond was that it would be available to investors on the street, so that any investor would be able to buy a piece of it. That was one of the stated goals, the stated missions, and we didn't get there with this bond offering. Let's be clear, in this rate environment, in this risk environment, the SEC requires me to say that your investments are more risky. Anecdotally, they're not. They're just not. I'll take your 2.5%, especially this week, against the U.S. Treasury 2.5%, anytime. We, for 30 years, we have gotten paid our interest, we have gotten our return on principal, and while mission-aligned investors are certainly the next big piece, your investments in CDFIs are attractive if folks know about them. They are good investments. We know that, and folks in the mission-aligned investing know that. So I think the first step has to be mission-aligned investors, but certainly, I look forward to the day where we can, on behalf of our investors, buy a piece of a bond that that helps finance housing in Appalachia. I mean, we're not that far from if we turn the clock back 20 years, that we're talking about multiples of billions or percentage of billion-dollar bond funds. That would have been crazy.
Yeah.
We're not that far from being able to have these investments available to the street.
You remind me in what you're saying, and we'll go to Kathy in a moment, but you remind me that so much about the functioning of markets, and certainly Adam Smith said this, has to do with social agreement. And that, so I think that's part of what we need the evidence and performance, certainly, but there is something about social agreement at the end of the day that makes things work. So Kathy, this is a really compelling idea, and it's a big idea. And yet, if I let me put my Fed hat on for a second and say the following, that one of the problems in the recent financial crisis was a misalignment of incentives. And part of that misalignment of incentives was people were originating loans that they weren't holding. And one of the extraordinary things about CDFIs, so the other side of the fact that you have no liquidity, right, which the bond was supposed to help, is that you're stuck with the stuff. And therefore you know it better than anyone. You know how to restructure it. And because you know it, and because you have limited liquidity, there are certain forms of liquidity that are available. Because you have limited liquidity, you have a responsibility. You're incented to have the asset work. So I guess one question would be, if we move in that direction, do we then create a misalignment of incentives which actually works against the originary integrity of the industry and the way it was structured, for good reasons, and I know that's not your intent, of course. But could you just speak to that a little bit?
Sure. I think intuitively, everyone signs on to skin in the game, the concept of skin in the game, of aligning two parties' interests toward a common goal. And so that makes sense. And clearly, there has to be accountability for performance. There has to be accountability towards good governance, and ultimately some kind of assessment as to whether whether your activity actually produced the objective that you intended to produce. So all of those things apply to this. And I have a couple of ideas about how you could do that, but I'm going to start with, well, is a mutual fund manager, do they have skin in the game? Nobody's here saying Trillium has to have skin in the game as an asset manager on behalf of its investors. Now, its investors hold them accountable, and if they don't like what Trillium does, they don't like the results that Trillium produces, they can vote with their feet and go someplace else. And so we do have an issue of liquidity in the assets, the pool of assets that we finance, that if an investor wants to exit, we have difficulty allowing that to happen because we don't have deep sources of liquidity to facilitate that. So, that to me says, okay, there's got to be either a liquidity support system that allows investors to vote with their feet if they don't like the performance of the CDFI asset manager, and maybe that's the role of government, is to provide some kind of liquidity. And then, yes, it's maybe my upbringing, but I also think it's partly why I'm in the CDFI world, is that performance matters, and we need to be held accountable for performance. And so how do you make that happen? And so maybe we do need some skin in the game in some form or fashion. Maybe there does need to be some kind of performance-based compensation as asset managers, so that our compensation as an asset manager is subordinated to certain performance on behalf of our investors. But the idea is to make it proportional. We are mission-oriented, and there have to be controls around keeping people who choose to be CDFIs to ensure that they stay mission-based. So our motivations are a little different than in the for-profit world. But if we're going to have skin in the game, it needs to be proportional to our objectives and to the amount of capital or skin that we actually have in the game. And so as an example today, that as principals, our skin in the game is 20%, 25%, 30%, because that's our net asset ratios, right? That's the standard. Yet, what's our historical loss ratio? Is it anywhere near 25%? No. Yet, that's today's definition of what current skin in the game needs to be. And I think...
And that's a growth constraint.
And that absolutely is related to the growth constraint. So if we're going to go to any model, whether we remain as principals or we adopt more of an asset management model, and we have to have true financial skin in the game, let's make it proportional to, one, the fact that we're mission-oriented, and so it's not just about financial performance, and two, has some relativity to what our actual experience has been, as opposed to, I don't know where 25% came from or 20% came from, but it's somebody else's view of what the right level of skin in the game has to be, and it has no connection to reality whatsoever.
Bill and I negotiated it with Frank DiGiovanni 15 years ago, I think. Just anyway.
So it's maybe time to move on?
Yeah, right.
Jeremy, this,
Yeah.
a lot of the comments just reminds me that we just have to be careful about pushing towards standardization, and because at some point it takes us away from who we are and acknowledging the fact that we are addressing gaps because the system doesn't work, and trying to force us into that box pushes us to a race to the top. The bond, I know you don't want to talk about the bond, but we left $175 million on the table because the box was drawn too tight. And I think it's a sign of sophistication in this industry that some people walked away because the funds did not allow them to do what we are supposed to be doing as CDFIs. I think if we CARS rated some of my borrowers, I wouldn't make a loan to some of our borrowers. I think it's an interesting schizophrenia that we have to exist with them, but we've got to remind ourselves of striking that appropriate balance.
Right, and I would argue to some extent that's native to finance, and that where maybe the tension is more taught in what we're trying to do. So let me ask one more question to everyone, and then we'll turn it open to the audience. We still have plenty of time. So I asked you each to present a provocation as a way to do this, and you did so, and I'm really happy with the ideas, and I hope that those ideas and others will infuse some of the conversation over the next few days. It was interesting to me that with the exception of the CRA, which had a public aspect to it, obviously, because it's regulatory, but it affected private capital, that none of your provocations really dealt, in essence, with the public sector, so directly. So, for example, if we think about the health of CDFIs since the 1990s, their growth point, a lot of it has been because of tax credit programs and because of the direct equity investments of the Department of Treasury's CDFI fund. It really could trace the growth, I think, from there, right? Some exceptions, but I think you could trace the growth. So I'm just curious, and you may not have an answer to this, but when you were thinking of provocations, you didn't say, let's create a federally sponsored federal home loan bank just for CDFI. You didn't go in that direction, right? Is it because you think that we're in a place politically where that is just even too impossible to provocate? Or is it because you think we need the flexibility of the markets, or how we define markets, to be able to grow, and therefore you didn't want to move in that direction in the provocations? I'm curious. Anybody?
I believe firmly and wholly that CDFIs can compete in the capital M market. I believe that you know how to lend, where to lend, and I believe that there is demand for investment in your organizations from mission-aligned investors. And so, while I certainly agree that we wouldn't have gotten where we are without infusion of capital from the federal and state governments, I think that what we need now from the federal and state government is more flexible regulations so that we can invest. And I think that y'all can compete in the market right up against, traditional lenders.
Thank you. Bill or Kathy?
Jeremy, I think we all know that the amount of potential capital outside federal and state budgets dwarfs what
Sure.
we're likely going to get within from federal or state governments. That said, you can look at the dysfunction that we're seeing now in Washington and know that we better not bet the farm on getting support from the Treasury Department or any other federal agency. I don't think that means we need to let them off the hook. I think they obviously play an important role, and we know that the stroke of a pen can either boost, as it has with the CDFI fund, our work dramatically, or it can pull the rug out from under us. I think the work that CFPB is doing around setting rules around abusive practices is as important a action that's come out of Washington in my lifetime relative to the impact on the communities we serve. But if we can figure out how to make ourselves more attractive, more of a necessity for private investors, I think we do ourselves much greater service.
Thank you, Bill. Kathy, did you want to add anything to that?
So, somewhat similar, but I think government can play a role both directly and indirectly, and I think it can have a more significant role in the indirect role that it plays. So, changing the framework, changing the regulatory environment, changing the legal environment around how finance works. Many of us grew up thinking that tax deduction on my home mortgage was, in the Constitution. It's not. It was a.
It's not.
It's not?
Obviously, it was an explicit policy decision that somebody made in Washington, and so I think government's role should be around where are the issues, where are the problems, and how can we create an operating environment that leads the market to positive outcomes, or at least in the general direction. And so I would say in my idea, it's more around changing the legal environment around the asset management industry, around the requirement of mutual funds to have to price their assets daily and provide immediate liquidity. I think there are government modifications or tweaks that could accommodate or facilitate an opportunity finance asset class that CDFIs could play a role in, and that way be more involved.
Very helpful. Thank you. I would just say one thing, before we thank our panel. The great theorist of innovation, Clay Christensen, talks about innovations in two ways. He talks about sustaining innovations, which are the kinds of things in an industry that help create efficiency and reach and quality, new kinds of quality in the industry, but sort of keeps the terms of the industry the same. That's why he uses the term a sustaining innovation. And then he talks about a disruptive innovation. Many of us sort of walk around with these in our pockets, right? They sort of disrupt the way we think about what communication or something is, or the terms of an industry. One day there are bookstores, the next day all the books are on your tablet, so that shifted that industry for better or worse. And I think by trying to lay out these provocations, what we were trying to do is sort of get ahead of the curve in our thinking by just saying, what are a few potentially disruptive innovations? What would be the things that disrupt? And I think the useful thing about doing that, besides the fact that these may be right and may be things that we want to pursue, is that it's a way to sort of understand what our industry is right now at the very moment by putting the outlier disruptions outside. So I hope you will join me in thanking the three panelists for the offers that they've made, and thank you for being such a great audience.